Okay, why don't we get started? Hello, everybody. I'm Jerry McHugh, President and owner of San Juan Resources, and I'm in our third installment of improving our San Juan IQ. We're talking about San Juan Basin natural gas market dynamics. And this month we have Sam Rasure, partner of Concord Energy. They market gas nationwide, from New York to California. Sam's been with Concord since 2009. He's VP of Producer Services. We also want to let you know that as we go through the presentation, we have a chat box or a Q&A box, and please feel free to fill that out, and we'll go from there on that. And I'll answer the questions, and maybe if you have questions too, we'll go there. I also have some polls, and maybe we'll do this maybe after Sam, but we have a couple of polls on what people predict natural gas prices to be this winter and next winter. So something that's new on this webinar situation here. We did change from Zoom meeting format to webinar, so everyone can be involved and not have a meeting format where everyone's looking at everybody else. So Sam, I'll turn it over to you. And
okay. Can everybody hear me okay? Can you hear me all right, Jerry?
I can hear you fine.
Okay, good. All right. Good morning. My name's Sam Rasure, and I'm with Concord Energy in Denver. And today I'm going to kind of give you a little bit of a market dynamics discussion on some pieces and basins that affect natural gas and natural gas flow and pricing in the San Juan Basin. I'm going to first talk a little bit about kind of a very macro view of what our company does and where we sit, and then I'll go into some market dynamics with some help from some slides with one of our partners, BTU Analytics, and we can go through and just talk about how gas flows in the San Juan and what are the things that affect it. So I'm going to start sharing my screen now. Okay, everybody got that okay? You got that, Jerry?
It looks great, Sam, thanks.
Okay, all right, very good. Anyway, Concord Energy is a privately held company here in Denver, Colorado. We have about 50 employees. We've been in existence since 2002. I joined in 2009, and we are, here's some legal stuff that everybody can read real quick. All right, good job. And so we're an integrated commodities marketing logistics company. We're very producer focused. We really work on being first purchasers at the wellhead and partner with producers to try to garner upside in aggregation of whether it be natural gas, crude oil, or NGLs. What we do is we try to change the commodity in space, time, or in form. In space, by transporting the commodity from producing basin to consuming basins or end-use customers. In time, we try to transform the commodity via storage. And then in form, we do some blending on the crude oil and NGL side. On any given day at Concord, we move about 3.2 BCF of domestic natural gas. And domestic, we do trade gas in Canada and a little bit of Mexico, but we just kind of call that domestic. And then we move about 200,000 barrels of crude oil and NGLs a day, and we oversee crude oil hauling in basically every major producing basin in the United States. We used to have a fleet of our own crude and NGL trucks, and about 3 or 4 years ago, we sold those, and we decided it was easier for us to outsource that and manage the process rather than owning the trucks. This is just a very quick, basic snapshot of where we have physical operations on the crude gas, and we do have a water business as well. That's a pretty minor business compared to the oil and natural gas. So I'm going to get into the logistics of natural gas in the San Juan Basin, first by just kind of showing you guys something you're probably all very familiar with, and it's really just the grid of the natural gas pipelines in the United States. Obviously, with the San Juan here, two of the big factors that come into play are really the Permian, the Rockies, and then actually the largest driving factor for all three of these basins is the demand in the West, okay? And we're gonna talk a little bit about how those basins interplay and what happens with production as it moves from producing region to consuming region. This slide talks about declining production in the Western United States, and what it's expected to do is really pressure the basis, and pressure meaning the basis will get tighter to Henry Hub. As you can see, the San Juan is somewhat declining, the Rockies is somewhat declining, but the Permian continues to grow in BTU's base case for forward production given forward price. But the big driver on the opposite side of this is where demand is. Demand in California and Arizona markets is flat to declining, while exports to Mexico have ticked up. These pull on Western Rockies gas and the San Juan Basin. And you can see that for the most part, demand will pretty much stay flat for natural gas into the desert Southwest and in California and into Mexico. The little blue piece on each one of these is the demand or the supply that's going into Mexico. This is a graph of essentially where San Juan production is. It's a declining basin, and BTU predicts continued decline given current forward price outlook. But the upside to that, to the producers who are still in the San Juan, is that you're going to have less competition for your gas. You're going to continue to see premium markets come get San Juan gas. There's a lot of pipeline in the Western United States that's set up to take gas to Phoenix, San Diego, Los Angeles, and it originates in the San Juan. So you'll have utilities come seeking that molecule still in the San Juan. So one of the major contributors to price and gas on gas competition is the Permian. And so the Permian clearly is right here. And what we're gonna see is the different ways the Permian gas flows. So clearly it flows to the west on Transwestern and El Paso pipelines. Whoops, sorry, wrong way. It flows, oh, there we go. You have northbound flow on Northern Natural Gas, Panhandle Eastern, NGPL. And then all the new pipes that they were building out of the Permian flow east to the Gulf Coast that kind of get into all the petchem and liquefaction facilities down on the water. And then you have direct pull off of Mexico. So the Permian can go in a lot of different directions. The dynamics of flow in the Permian have changed since the major growth in production has started. Let's see. So this slide talks about what Permian growth has looked like. So, you know, growth beginning, the red line is the natural gas in the Permian from 2016 up until January 20, you see a big growth from 4 BCF up to 12 BCF. And then we had the big disruption with COVID, et cetera, driving price, also combined with the Saudi-Russian oil fight that really tapered off what crude oil was doing and, in essence, natural gas was doing in the Permian. It's really predicted at this point that with this slowdown, the new pipes that are coming on, and that they're represented here, here, and here, won't be full for some time. You may not see a need for a new pipe out of the Permian with what's slated until 2025. And this is a really good slide. It just shows all the different outlets for Permian gas on Transwestern, NNG, El Paso, NGPL, Gulf Coast Express, etc. You guys can read all those down at the bottom, but it's a good slide showing the stack of takeaway out of the Permian. So this slide is kind of a time-lapse slide, and so what's important to look at is up here in the upper left-hand corner. We can see how the Permian used to be an aggregation point for gas in the Mid-Con, gas out of the San Juan, and then it was redistributed into Gulf Coast, et cetera, different locations. In 2010, you had almost 60,000 a day from Oklahoma, Kansas, southern Colorado, pushing south into the Permian. And in the San Juan, you had 225,000 moving south into the Permian. And then if you pivot over and look at the purple arrows, you have 1.1 BCF a day flowing out of the Permian up into the mid-continent, and 1.1, almost 1.2 BCF flowing out of Waha into what is the pipes that service the San Juan, basically TW and El Paso. The other difference you see is that Rockies gas in 2010, you had half a BCF flowing south down to the San Juan, and that's reversed into a northbound flow out of the San Juan. And all of these things are being driven by this SoCal demand. SoCal, they call it SoCal demand, but in the summer, it's also really a Phoenix, Las Vegas demand as well. So the next piece of this, the next slides I'm going to go into kind of address what's going on up in the Rockies and how it relates to the San Juan. These first few slides are what's the Permian doing supply-wise, and now let's talk about the Rockies. So the Rockies is kind of split into two different plays, if you will. There's the Western Rockies, which is mainly dry gas basins, Green River, Overthrust, Piceance, Uinta, and then the wet plays of the DJ and the Powder River. In the last 3-4 years, DJ, Powder River have seen large increases due to the NGL and crude oil content in each of those basins. Well, we've seen a real decline in volume in the Green River and the Piceance and Uinta. And what's happened is that that's created a premium at kind of the Opal or the Kern receipt area, because I'm going to flip back one slide. So if there's this big pipe that you can barely see here, this is Kern River pipeline, and that starts right here at Opal. So what's happened is you're seeing San Juan and Permian gas migrate north to get into this Kern receipt area where the gas can get into the Kern River pipeline and then flow south into the Southern California markets. So on one hand, we have this supply growth on the south end with the Permian, and then we have a supply deficit, if you will, out of Green River, Piceance, Uinta. There is absolutely a finite amount of gas from the Eastern Rockies that can get to the Western Rockies, and you have WIC, CIG, Overthrust Pipeline, REX that can move gas this way, but those pipes run full every day, moving gas from the Eastern Rockies to the Western Rockies. So this graph just illustrates what we were talking about in the last slide with the Greater Green River, Uinta, and Piceance basins declining. And that decline will create demand for San Juan gas. So that San Juan gas will find that premium market heading north, and you can see that in the flows on the pipeline. This last slide is a good illustrator of price, and what I just talked about in the preceding slides is borne out in price. You had El Paso, San Juan, Waha, and Henry all really trading at parity from 15 to 16. And then in 17, you started to see the Permian gas start to show up. And then it really started to show up in a big way in 18. And then in 19, you had just not enough takeaway out of the Permian. So you had all this Permian gas flowing up into the San Juan, depressing price here. That's the creation. You have this big glut of Permian gas that pulls down the San Juan price. So what's happened now with the reduction in volume in the Permian is you've seen things come back into parity. The Permian can balance. There's enough pipeline takeaway to go out to the Gulf Coast, to go to the West, where the Permian doesn't have to price to compete. So on the go forward, I think with COVID, you've seen a pause that has allowed the Permian to catch up in a way. You'll continue to see the Rockies decline, and that continue to be a premium market for San Juan gas to go north, in addition to the traditional outlets for San Juan gas that are the SoCal region and Arizona, where those utilities come up and they buy gas in the San Juan. So I've really clicked through these pretty quickly. Jerry, are there any questions? Are there any slides anybody would like me to go back to and kind of talk to a little bit more?
Can you hear me, Sam?
I can hear you.
We had a question from Jason Sandell. He had raised his hand.
Okay.
You got to turn your mic on, Jason. You have a question? Jason is with
Jerry, thank you for that. I did not have a question. It was an accidental hand raise.
Oh, okay. Okay. Well, I've got a couple for you here, Sam.
Okay.
If you have put your questions on the chat or raise your hand, because that works. If I turn you on, you can ask the questions. So traditionally, my experience in the last 40 years, the San Juan has been like a storage field for Southern California. We kind of chuckled that we were the swing producer, and it still looks like that's the way we are today. I know our basin makeup was a lot more predominant, say in 1995 to 2010, or even before 2010. We had huge volumes, and I mean, I think what I'll get a chance to show what that production was. But any comments on that, Sam? What the significance of the San Juan? Are we just going to be a swing basin that's going to fill in those gaps?
I wouldn't necessarily call San Juan a swing basin because of so much of the transport that utilities own. SoCal, San Diego, Southwest Gas, so many of them own transport on El Paso and TW that has primary receipt points in the San Juan. As the San Juan declined, definitely some of those utilities were trying to reach back and amend some of their contracts to have primary receipt into the Permian. But I don't think the San Juan is necessarily in a bad spot as far as demand goes, because you will continue to have utilities reaching back to grab volume at the Blanco hub. But then you also have the ability to get north. That slide that I showed, this slide, this ability to get north for the San Juan is also important, because you can also you're accessing, in essence, that Kern receipt market, and that Kern receipt market is not only supply into Kern River to get down into Southern California, but that's also really the market for Salt Lake City. So the San Juan is in a dynamic location. It's between a huge producing basin and a huge demand basin, or a huge demand center in Southern California, but it also has demand needs further north, and that's bore out by this northbound flow going to get the highest price.
Well, and as I look at that map too, there's so much pressure of the Permian coming from the from Waha up that El Paso 1.188 per day
Yeah.
coming up to the north. And San Juan intersects with that. So, I mean, essentially San Juan molecules could be going up to Opal and then current and back to California that way too.
Correct.
If
Yep.
there's
This
demand
this segment of pipe definitely maxes out, has been maxed out for the last year or so.
Okay. Someone typed in a question here. This is from Leon Romero. Hi, Leon. What is the expected timing on the increase in takeaway from the Permian to the east?
So if we can pivot back to that slide. So let's see that this is you can see that, you know, there's a Jan 2020. You can match up the time frame. So there's a Jan 24, Jan 21. You know, this is a mid 21 time slot. And those tranches of transport, I feel like are pretty safe that they're going to still get built. But as you have pipe that is not in the ground yet, and you have this dip in production, these pipes that are further out become less sure. I mean, I don't know if all these pipes have reached final investment decision. I would suspect these first two have. The last one out here, which is this Permian Global Access. No, it says right here on this slide, pipeline no FID has been made on this one, and I had not seen that. So FID has not been made on this last pipe. So, you know, it just kind of legs in 21, 22, and given where the anticipated production curve is, we should have enough pipe out to the east so that the Permian is not pushing as hard on the San Juan price-wise.
Okay. You did show that Mexico growth had been steady. Of course, the Pemex and the Mexican government is going to say that by 2025, Mexico forecasts to be producing all enough gas for themselves to handle that. Do you have some comments on that little bit of Mexican demand that you show here at the top?
You know, El Paso Pipeline has made significant investment in having outlets for their gas, not only in the Permian, but let me get to this. So El Paso Pipeline is down here, and you can see that they've made significant investment to get interconnect into the Mexican border. I would speculate that the 2025 idea for Mexico would take a serious effort by their E&P community to supplant all of these deliveries of what is very inexpensive natural gas into their northern border. And for them to be free of U.S. natural gas in 2025, I don't think it's very realistic. There's a lot of gas flowing south into Mexico right now, and a lot of it is this Permian gas.
On the and just on that area, what I think is very interesting for us New Mexico producers is that, and correct me if I'm wrong, there's 15 interconnects into Mexico in Texas and 4 interconnects into Mexico from Arizona. And I don't know how many for California. And there's 0 interconnects into Mexico from New Mexico, which, I mean, technically much of the New Mexico gas may go through Texas into Mexico. But as far as the San Juan Basin, we're pretty much locked out of that. Yeah,
I mean, it's really kind of around this El Paso location. And I think a lot of that was dictated, Jerry, by some of the Mexican pipe, not as much the the U.S. pipe. I mean, I would consider, you know, that these interconnects right here are that's as much southern New Mexico gas as that is Texas Permian gas.
Yeah. Let me see any more questions anybody else has here. Well, that was a really good rundown of what the San Juan is and how much transport is owned by the utilities. I remember when gas marketing, the New Mexico Oil and Gas Conservation Division had a gas marketing arm back in those days, and we'd have trade shows in Santa Fe, and you got to meet all the marketers and people that were moving gas to California, to Texas. That was really pretty much the early days of the gas marketing world. And I guess we stopped funding that in New Mexico in the last, I don't know, 10 or 15 years. Okay. Let me put a poll on the screen here for everyone to do. And what this is we're going to shift directions a little bit here. This is a poll to what do you predict natural gas pricing to be at its monthly high this winter? And this is a NYMEX number, Novi, March to March 21. So if you can vote there and see what people are coming up with on these sorts of numbers. It's kind of a new interesting thing that Zoom has here. There's got to be some function where I can show that. For what it's worth. A few more people voting there. Anybody else to vote on the polling? Okay, I'll end it here in just a second. Your votes are not binding and they're anonymous. I don't have any. I turned on the anonymous part of the polling on. So, okay, so for the results here, we have 6% think it's going to be in the $1.50 range. 41 and 41% are in the $1.50 to $2.25 range, and then also 41% in the $2.25 to $3 range. 12% of you think that it's going to be in the 12% range. And when I asked Sam this yesterday, what did you say, Sam? Was your thoughts on?
I asked you how cold it was going to be. That's what I asked you.
It was a weather question.
Yeah. So I will say this, Jerry, that we have recently seen in Southern California, the SoCal utilities have been able to, they've gotten back a lot of their storage that they had in the past was sold out to kind of commercial marketing types. They had a big chunk, I want to say it was 2 or 3, it might have been 3 BCF of Southern SoCal Citygate storage that was contracted out to marketing types. I think that might, them holding that capacity might make, it might make volatility a little bit less at the SoCal Citygates during the coming winter. And understand the California market is truly a winter market. I know everyone may think that it's a summer electric market. They have a lot of demand. They have a lot of demand in the winter. So.
Okay, I had another question here from Leon Romero from Santa Fe. Any new electric power plants on the drawing board that you know about, Sam?
The big thing that I do know about is just the decommissioning of the big facility in northern New Mexico. The that I think there's some groups are trying to push toward gas. I don't know that those are really long dated processes. But I will say this, that the utilization of electric cogens in the state of California has been pretty robust this year. Well, and maybe I shouldn't say in California. A lot of the cogens lined up on the border of California so that California can label that electricity as import electricity. I'm not sure if that answered your question. Just a little bit of
Okay. Nothing new though.
no.
Okay. Let me share one thing myself here. This goes along with what you talked about, your slide on the San Juan Basin demand. This was from the San Juan Energy Conference a year ago. It was May of 2019. And the red, of course, is the natural gas production since the 50s. And the blue is the oil production. You can see here, are you all seeing that? Okay, no one can raise their hands here. It's this webinar. You can see the Mancos activity really pushed by Encana and WPX initially, and then they sold out to DJR and to Enduring. Logos is obviously big out here still, and then there's some other small producers. But you can see the Fruitland coal bed uptick and just where our demand was. So I'm sure the graph from the 95 to 2010 shows San Juan being a significant portion of natural gas supply for the basin. So Dan Fine asked if he can do you have a question, Dan? I can allow you to talk if you'd like to. Let me ask you a question, or I'll put you on allow to talk if you have a question, Dan. You'll have to unmute yourself too.
Can you hear me?
Yes. Yes.
All right. I have a couple questions and a suggestion. One is, could Concord comment on what happened with Dakota Access Pipeline decision, which, as we know, has suspended by way of a district court in Washington production in the Bakken for 13 months. How does that impact on gas flow from the Dakota Access, then that big pipeline that's being closed? How does that change the flow and possibly for the Permian and more important for San Juan? Are there a price beneficiary in both cases, or is there more of a supply opportunity?
So the DAPL issue, well, for one, it's going to one of the first things we heard is that it would take a lot of time to even drain that pipe out of service. I know that they're fighting back against it. I don't know the latest, meaning as of today, what the latest word is. But as far as supply goes, essentially what that will do is it will revert so much of that crude oil back to a rail state. The early days of the Bakken, which are not that far away, back in 2008, 2009, when the Bakken really started to get going, all that oil was really moved via rail. And so there are massive rail terminals in the Bakken. And so instead of the $4, $5, $6 tariff that those producers would be enjoying going down DAPL to get to a TI Cushing type price, they are going to have to put this product, a good portion of that product will have to revert back to rail, which will is a $10 to $12 deduct. So that's painful. So my feeling is that, well, on the gas side, the gas side will be dictated by what happens on the crude oil side. So if price can support the producers in North Dakota putting the product on rail, you'll have continued gas flow. The gas flow today is 1.5 to 2 BCF given the day. And then if you start to see some of that oil shut in, that gas all really goes from North Dakota directly into Northern Border Pipeline and heads straight to Chicago. That's essentially what that gas does. And it competes directly with the AECO market. So you could possibly see a little bit of a short if oil were to shut in because of price. So a decrease in gas, a decrease in the flow from the Bakken into Northern Border Pipeline. But I don't know that it will be that significant to really affect what's going on in Chicago, because there's so much gas in Alberta that can just really kind of supplant any of that Bakken, what might be perceived as a supply interruption. Am I kind of touching on what you're looking for question-wise?
Yes, it's one part of a bigger question, and that is looking at the decision in the Atlantic coast to shut down and move away. But Duke Energy has done this after spending $3 billion. The Atlantic coast Marcellus line is finished.
Mm-hmm.
Secondly, the gas now, despite the lowest cost in the Marcellus, is almost stranded in the future because it can't be, the takeaway to New England is also blocked. And so I'm looking at the pipeline situation, the impact there in the east on gas going from the Permian into basically the market in the Central American, the Mid-American market, and of course San Juan. I see in my picture now a pipeline risk going forward, and I wanted to make that point because we're going into a presidential election, and I do see restraint from the Biden side in terms of natural gas transport, production, and regulation coming up. Do you have a comment on that?
So as far as pipeline constraint for the Marcellus, clearly the defeat or the Duke Energy's give up on the eastbound pipeline to more East Coast supply or East Coast demand certainly hurts the Marcellus. But I do think that there's enough pipe out of the Marcellus to manage the production that's there. I think that it just ends up putting more pressure on the Midwest markets, Detroit, Chicago, because a lot of that Marcellus gas will just end up right back there if it's oversupplied. The other thing is you'll also see a lot of southbound flows on ANR and NGPL when demand dictates. So if you don't have the demand sitting in the Midwest, in the upper Midwest, in Detroit, Chicago, Minneapolis, the Marcellus gas does have the opportunity to then fight for market by heading south on ANR and NGPL and TEDCO and Texas Eastern out of the Lebanon hub. So I do think that the incremental pipeline into those premium East Coast markets was that would have been good for the Marcellus, but I don't know that it'll be the death blow of the Marcellus. I think the Marcellus is just a very prolific basin where there's so much gas there. There have been for the last few years so many different pipes aiming to go get that gas and move it, like Rover and Rex and Midwestern Pipeline. So, and then as far as the political side of this ball. What happens, in the short term politically if we end up with a less favorable candidate, a less favorable candidate to the industry in the White House. My speculation would be that in the short term, that might be good. That might be good for price. You might see people scared of incremental production coming on, and you might see a price uptick. It would, and that's purely speculation on my part. I don't know the answer of what will truly happen, but I could see that if you have any restrictions to drilling and you start to see a macro decline take hold of the major producing basins in the country, clearly you'll see a price uptick.
I agree with you on the price stimulus coming up if it's a Democratic win, especially in the Senate. But I want to move on to what you said about Mexico. I had professional relationships with Mexico, with Senegas in the previous administration, working, as Jerry knows, to extend pipeline access to Guadalajara from New Mexico. And with the change in government and the new president, that came to an end. But at the same time, overriding the political was the lack of demand in New Mexico. Demand structured around capacity. There was excessive capacity in 2019 going into 20 in Mexico for gas and for the gas potential from the Permian. The Permian has the gas. Mexico does not have the capacity and the demand for that gas. So my running comment on this is that the last indication from CFE taking more Permian through ET, energy transfers from Texas, and meaning the Permian, indicates there's no real future for short term in Mexico for San Juan gas. I was working with the previous administration here to expand that, the option of Mexico taking San Juan gas as a preferential or as a mix with regard to the Permian. I see now that's closed in the current administration. I also would say that looking at Senegas projections, the import of San Juan or even Permian gas should taper off about 2024 as Mexico and Pemex begin to develop the late technology and move toward more self-sufficiency in gas. I think that's what was planned in the previous administration. But the point is the potential for San Juan gas going into that flow, it's almost non-existent now, going to Mexico from New Mexico because of the overwhelming export of Permian gas. And the last contract, that Guadalajara CFE deal, I think puts a cap on that. Can you comment on that? Competitiveness with Permian gas and San Juan gas in terms of the Mexican market and what you see?
I agree with you that there's connectivity to Mexico. There is just not the demand. I completely agree. And I think that any increase in demand in Mexico will result in more Permian flowing south. But in essence, that will lift all boats, because the molecule in the Permian now is staying in the United States and competing directly with San Juan gas, because a molecule is not quote unquote scheduled to a Mexican market doesn't mean that increased Mexican market demand won't lift all boats. So because once it hits the pipe, it's just molecules, right? So the more demand you have in Mexico, the more uplift you get in the Permian, and you end up with uplift in the San Juan. So and I think you guys probably know more about the Mexican political picture than I do. And if you feel like that market may somewhat go away due to domestic Mexican development, then I would side with you that a lack of pull out of the south from the Permian into Mexico could be detrimental to San Juan gas in the future, because you'll have more Permian competing against the San Juan.
Yes, and the final question, and I appreciate that comment. I think it's you're on the side of realism with regard to Mexico. I point out that Senegas projection in the previous government was 2025. They were aiming at essentially the development of gas production capability in Mexico. And then, of course, Pemex is now the public company, the state company, with the mission by the president to move towards self-sufficiency. But I don't have dates or times or even a speculation on that, because the gas is cheap going from the Permian. And they'd have to, if they do a price economics in terms of project development, I don't think they can raise money to do this against the import of gas. Now, the final question is this. Some people in the San Juan Basin and others in possibly, I think, going to Oregon to the Cove project for export of LNG continue to think with, I think, a good deal of hope that this Asian market can be open to Rocky Mountain gas, and then, of course, San Juan gas in the future. My comment on that is very gloomy at this point. I have pointed out publicly that when you look at what Sempra is doing and what Sempra says it's doing as a major part of the export of gas to Asia, the Baja project, for example, Sempra is putting all its eggs in one basket at this point, and that's Permian to the Gulf, because they are LNG in the Gulf. And I don't see a change in that. And then politically, Sempra is now in a NASA type, well, the three signatures are just 2 weeks old for the new Mexico, United States, and Canada agreement. Sempra has entered a challenge. It is suing Mexico, the government, for discrimination against foreign ownership and production. And I think that's kind of to the Mexicans and to the Mexican government now in present, puts Sempra outside as a, for us, that decision is essentially a bad political U.S. company which has equity in Mexico. It looks like it's going to be downhill unless that is cleared. That's that litigation and that civil suit, Sempra against Mexico. Well, can you comment on that? Because there is always some lingering hope that there can be some takeaway capacity from the San Juan through the west, the north, with the western line, getting some of that gas in a mix with Permian, and it goes to LNG facilities in the Baja. That hope is there, and I hope maybe you have looked at that and can give us some guidance.
I would agree with your thoughts on that. The drivers for that simply in today's market, the JKM price, which is the price for delivered LNG into the Japan-Korea market, is so close to parity of Henry Hub that that you're having cargoes rejected out of Gulf Coast facilities. We have nearly 9 BCF a day of liquefaction on the Gulf Coast, and we're using about 4.5 BCF of it. You're going to have to, the only way you drive toward another LNG facility, one that may be on the West Coast or wherever it is in the United States, is by demonstrating that there's demand for it. And currently in today's market, there's not demand for it. That's not to say that 2 years from now you don't see that demand pick up, but in today's market, we are underutilized by 4 BCF a day of liquefaction in the Gulf Coast. And the only way that that liquefaction starts to ramp back up again is by price spread. JKM, the NBP, National Balancing Point in England, those prices have to depart from where Henry Hub is. They have to go well above Henry Hub to support the idea of liquefying, shipping, and then consuming in foreign markets.
Okay. Well, that was a good detour, Dan. Thanks for the questions on that with regard to Mexico gas and how that affects the San Juan and the Permian. One of my big takeaways is your slide, Sam, on the huge volumes from the Permian. It's not just a supply aggregation place, but it's a supply place of huge volumes of natural gas that compete with San Juan and Rocky Mountain gas. And now it looks like things are starting to, we're looking for some equilibrium here. So I think this is a very good presentation. I want to thank everyone for joining us today. If you missed out, we had a little new webinar glitches I had to figure out at the beginning how to let everyone in. So I think we'll have that figured out for sure next time. And we'll have our next share will be on August 18th, Tuesday, 9 a.m., third Thursday of August. Not sure what the topic will be then, but we'll get something that'll be, I think, provocative for people interested in the San Juan Basin. And I know I get I learn a lot every time I listen to one of these things and participate because naturally I'm curious. And thank you, Sam, for your time, for your efforts here and painting a very business-like neutral picture as to what's going on supply and demand in our Rocky Mountain area. So with that, we'll adjourn, and so we thank you everyone for your participation and being involved. Thank you very much. Bye.
Thanks, Jerry.
Thank you. Thank you.